Dear netizens, actually, every night around 9 o'clock, I do three things at the same time. I watch TV series. Currently, I'm watching a Japanese series. I didn't know about things like foot covers, wearing them to walk around the house. A century-old company went bankrupt because people stopped wearing them. They had to switch to making marathon running shoes. These stories of struggle, I find them interesting. I really enjoy watching these movies. Chatting with netizens on Clubhouse. Watching the stock market. Playing with my bird, sometimes playing with the cat. Now I hold the cat every night. I have a great bond with the cat. Of course, watching the stock market. Paying attention to the most important economic news. The most important news last night, the Federal Reserve announced that it would keep interest rates unchanged. But this is not the crucial thing. The crucial thing is undoubtedly the issue surrounding what was said. The whole world knew the interest rates would remain unchanged. I am worried about the issue surrounding it, but there's nothing to worry about. The issue surrounding it might make another major mistake. London cybercrime. Register quickly by June 7th. It fills up quickly. The U.S. Federal Reserve unanimously approved. Means everyone approved. No objections. The federal funds rate remains at 4.25% to 4.5% unchanged. What has been added? Increased uncertainty surrounding the economic outlook. Uncertainty of the economic outlook. Not sure which direction it will go, whether it will lead to inflation or recession. How to balance employment and inflation targets. Starting in April, slowing down the balance sheet reduction. This slowdown in balance sheet reduction is a sign of concern about a recession. The dilemma for the Federal Reserve is, are you afraid of a recession? In the trade war. Under circumstances of trade war, exports might decrease. Imports might also decrease, and the government is cutting the budget. Will there be a recession? However, the tariffs on imports will also cause prices to rise. So, are you worried about inflation? The Federal Reserve's mandate, first, is to aim for inflation. Long-term inflation, to be capped at 2%. Second, is to aim for full employment. These are the only 2 points. How do you balance these 2 points now? The statement indicates stable economic expansion. It is still quite stable now. The unemployment rate is stable, at a low level. The labor market is robust. New job creation. Each aspect is quite good. Inflation is slightly high. Seeking over a longer period. Maximum employment. Maximum employment and 2% inflation. This goes without saying. All right, let's take a look. In April, slow down the balance sheet reduction. By how much? Originally, reduce $25 billion in government bonds. Reduce $35 billion in mortgage securities. That is every month. Reduce by $60 billion. Reduce by $700 billion a year. The Federal Reserve's balance. Now reduce government bonds to $5 billion. Contain $35 billion mortgage security. That is $40 billion. Reduced $60 billion, $40 billion. Balance sheet reduction month. Less by $20 billion. Let me show you. In 2009, 3 rounds of quantitative easing. So-called quantitative easing means the Federal Reserve expands its balance sheet, essentially printing a lot of money. But what wasn't used was kept in the Federal Reserve. The Federal Reserve originally had only $500 billion on its balance sheet. Guess how much it expanded to? At this time, it expanded to $2.5 trillion. $2.5 trillion. Then by 2022, during the pandemic, the balance sheet was trimmed here. This is the balance sheet. This balance sheet using the pandemic once reduction reduced a little bit. Then it really skyrocketed upwards. This was impressive. $2T to over $5 trillion. At this point, the first phase of balance sheet reduction began. It reduced quickly. It cut to $100 billion, over $100 billion. Later, it cut to $60 billion. Now it's reducing a bit less. The current level is $4 trillion. $4 trillion. You know, when the economy slows down, indeed, the ferocity of money depreciates. You need to loosen the money supply. If the ferocity increases, you take the money supply back. Maintain the looseness and flexibility of street money. At this point in time, they have decided to reduce the balance sheet reduction. Actually, firstly, there's a bit of fear of recession and overall economic stability. According to the dot plot, this dot plot is very important. What do they expect? Each person's dot, they think. When should the interest rate be at what level? It's estimated that by the end of the year, the interest rate will drop for most people down to here, 3.75% to 4%, with 2 rate cuts. Expect no rate cuts this year or just 1 cut, but most people expect 2 rate cuts this year. It should likely be reduced to here. New article, the Economic Uncertainty Index. Typically speaking, the Economic Uncertainty Index is approximately 100, but in 2008, the Economic Uncertainty Index was over 200. During COVID, the panic reached 600, and now it's nearly 400. As you know, the market is almost different. So everyone can be concerned about this uncertainty. The most important thing is Powell's speech. Powell said, if the economy remains strong, he will maintain higher interest rates for a longer period, and if the economy remains strong and inflation doesn't drop to 2%, we can sustain restrictive policies for a longer time. Which means if the economy continues to do well, we will keep it here, the so-called restrictive policy, meaning relatively high interest rates. This way, it restrains economic development, hoping inflation will fall back to 2%. If the labor market weakens and inflation drops quickly, then interest rates will be reduced. It's clear, he looks at the data, Powell. He is very data-driven. He doesn't make predictions, which I think is an issue for him as the Fed chair, unlike Greenwich. Unlike Green's Bank, GDP growth was estimated at 2.1% in December. Now it's estimated at 1.7%. Unemployment rate at 4.3%, estimated at 4.4%. Economic growth has slowed. Core inflation has increased. Median interest rate at 3.9% hasn't changed. From last December to now, he believes GDP growth has slowed and core inflation has increased. That's his main point. I will provide a comprehensive and detailed analysis shortly. He mentioned that the market's general inflation expectations have increased, but not too much, in the near future. A quarter chance, source of inflation. I will explain shortly. The government is reforming in 4 areas, which have a significant impact on currency and the economy, namely trade, immigration, fiscal policy, and deregulation. I will discuss those 4 points with you. He observed the Consumer Confidence Survey, which shows a significant rise in expected inflation. This unsightly data is based on the market. And other surveys, comparing long-term inflation expectations. This is very dangerous. People on the street expect inflation to rise, significantly increase. But the survey data and concerns about economic downturn, sometimes survey data and economic data do not align. This is true, but sometimes it is very wrong. It is self-fulfilling. Let me summarize what he said. The slowdown in growth in 2025 and the rise in inflation offset each other. Highly uncertain. The economic slowdown in 2025, along with rising inflation. These two things offset each other. In principle, inflation should not rise with an economic slowdown. Rising inflation is supposed to bring economic growth, and these two things are highly uncertain. Let's take a look. The bank did not predict a recession, but the market, having experienced a recession, I would say, theoretically speaking, tariffs are a one-time thing. Once increased, they won't continue to rise. However, if both things occur, it becomes persistent inflation. One is the disruption in the supply chain, and the second is the inflation expectation mindset. If tariffs are increased by 8 to 900 billion, and the long-term consequences are equivalent to 4% to 5% inflation, I believe that 4% to 5% inflation will definitely trigger inflation expectation mindset. This is my view back in 2022 when the supply chain was tense. Powell also believed that the supply chain tension would come down and did not expect inflation. As a result, inflation has reached where it is today. Historically, there has never been a case where inflation rises by 2% to 3% without triggering inflation expectations. That's my answer. The new government, in terms of trade and immigration policies, impacts the economy. This triggers the economy. This is the University of Michigan. Consumers believe inflation is rising, which is very dangerous, so it completely depends on how much tariff Donald Trump will impose on April 2nd. Right now, I estimate he won't impose them all at once. Right now, my sense is that he will impose a portion, and then add the second portion 3 to 6 months later. But the immediate tariffs will be on Canada, Mexico, as well as automobiles, semiconductors, and pharmaceuticals. How much is this? This adds up to about $200 billion US. Donald Trump really needs these budgets. Survey data shows that the risk of economic downturn is rising, but despite the survey data, people are worried, yet the correlation with economic data is limited. People's perceptions may not be accurate. If the economy is strong and inflation hasn't dropped to 2%, there will be high interest rates. If the labor market weakens, interest rates will be reduced. This is the main point he was making. So what was the result? Here, they feel he was bluffing. The stock market surged and then fell, and the Standard & Poor's wasn't as impressive. The result? There was indeed an overall increase, with most things going up. Donald Trump said that the United States Federal Reserve Board should cut rates because tariffs were coming in, which could potentially weaken the economy further. He called for a reduction of these tariffs as well, but they didn't listen. They didn't listen to the call for rate cuts either. Will there be a rate cut in June? Let's see how the tariff increase on April 2nd plays out. I'll reiterate my prediction. Canada, Mexico, automobiles, semiconductors, and other things, including pharmaceuticals, were immediately increased. This adds up to $250 billion, and now he has added more, another $250 billion. This is a 1% inflation. Within 6 months, equivalent tariffs will be imposed. Equivalent tariffs mean an additional 20% tariff on the rest of the world. In principle, the U.S. economy will decline by 2% because of this, reducing by 2% and teetering on the edge of recession. The Federal Reserve should do the right thing. April 2nd is Liberation Day. The introduction of tariffs is significant. The Singapore Bank stated that the Federal Reserve believes tariffs will not lead to stagflation. It is predicted that there will be one interest rate cut this year. The investment advice is to increase stock holdings, cautiously hold long-term bonds, and have a bearish outlook on the US dollar. He believes that the Federal Reserve thinks stagflation won't occur. First, you need to understand that if stagflation happens, it means a long-term decline in stock prices. The Federal Reserve is more sensitive to the risks of weak economic growth than to rising inflation. They believe the chances of a recession are more significant than inflation, maintaining a tendency towards a loose monetary policy. It is predicted that there will be only one interest rate cut by 2025 or in the first half of the year. The Federal Reserve fears a recession and is more moderate compared to market expectations. There is no strong data to justify adjusting interest rates, meaning neither an increase nor a decrease, with the market focusing more on the risks of weak economic growth than on inflation. June Lee from Henderson Investment suggests that the Federal Reserve views inflation as temporary. The market interprets this as a rush, indicating no need for a rate hike, which has encouraged stocks and bonds.